Do you want to know why Dan Bird was not on my channel last week? It's because he went to this freaking thing called The Money Show, but it was a lot of fun. I kid, I jest. I'm glad he's investing in himself. He actually learned something that we're going to talk about: timing strategies. Dan, I don't know if you saw the comments, but let's just say about 100 people missed you and left
Wow.
comments going, "Where's Dan? Where's Dan? Where's Dan?"
Wow, that's a lot. Yeah, sorry we couldn't do this when I was in Orlando at the Money Show.
Yep.
The Money Show, how to print your own money.
That's not what it was about.
No, no, it was a kind
Uh,
of a conglomeration of different things, different strategies, stocks, real estate. There was a little bit of everything, really. Bitcoin,
oh, wow.
and all kinds of different things. Some people that are recognizable. They've been on CNBC, were there talking, and a bunch of booths. And I talked to a whole lot of people. I actually went there to see if maybe I might do a booth myself next year.
Oh, wow. Okay.
So, which it might be a good venue actually for it.
Nice.
But what I want to talk about in this section is something that I learned from one of the booths. I'll actually give them a plug and show their website. It'll be a free plug for them, and people can do whatever they want. I am not an advisor, so I am not going to recommend what to do with your money, what to buy. This company does, and they had a very interesting approach of how they do it. It's a technical analysis approach, which most people had no clue what they were talking about. But I spent quite a bit of time talking with them, and they realized pretty quickly that I knew exactly what I was talking about, and I kind of decomposed their system.
Oh, wow. Okay.
I reverse engineered their system.
I bet they
So,
really enjoyed that.
well, they don't know that I've reverse engineered it, but I think they know that I could, but I've actually done it, and that's what I'm going to show right now.
Okay. Oh, wow.
What
Okay.
what I learned and what I've done with it, and then what I'm going to do moving forward to kind of track this system,
Okay.
because it's pretty cool actually the way they do it. All right, so let me share. Try to get through this pretty quickly if I can. For those that are interested in getting my newsletter, you can go to breakpointtrading.net, and the newsletter is right there on the main page, right on this button. Don't need a password or anything, just click on that. And I put this out every week, roughly about 1 o'clock on Saturday Eastern time. Should be out there. By the way, one of the things that's always on here, and we talked about this in the previous session, I meant to show this, but I forgot to.
Yep.
When you said you were talking, or you saw somebody say, we're going to have a melt up
Yep.
scenario,
Yep.
right? And I said, that should not be shocking to anybody. So this is on the front page of my website. It's always here. I update it each weekend. This is the secular bull and bear markets.
Right.
Secular bulls, as I've always said, last about 18 to 20 years. And we may still have about 6 or 7 years left in this one. And you can see that even when this one started, you can count it from 2013 when it broke out, or 2009, which was the low, but it never went below the 200-week moving average right here.
Mm-hmm.
And it still has not. In fact, it came down to the 21-week in this last little bear market. The sell-off we've had that everyone's so concerned that we're going to the bottom again. Mm-hmm. It never went below the 21-week, and it got right to it and bounced. And we're heading higher again. So this is going to head higher. This is going to take out the previous highs. This is going to go much higher over the next 6 years, in my opinion. So I've been saying melt up for a long time.
You've been consistent, that is for sure.
Right. But yes, it's just my opinion. Just using the charts and using the data, basically. So if any one of these three turns red, and it will be on here every week. You don't even need a subscription to get to the main homepage. Right. But every week I'll have an updated one on here. You can see whether any of these have turned red yet. And none of them have. Got it. So let's talk about, let's see, let me get rid of all these things. Let's talk about what I learned at the Money Show. And one of the things that I will do is I'm going to show the website of this company, Turner Capital Investments. They had a booth there, and I spent quite a while talking with them. And they actually had this chart, and they had another chart up there on the screen. And most people had no clue what these charts meant, but what they were saying is this is how we determine this is our timing strategy. This is our strategy for getting in and out of the market. And what they do is when it gives them a bullish signal, they get in with a double leveraged ETF. So for the NASDAQ, it would be QLD. Okay. They do a double QLD. And when it gives them a sell signal, then they switch and they do a double leveraged inverse ETF.
Oh, wow.
QID. So they make money on the downside and they make money on the upside. And I thought this was a fascinating strategy. Now, they actually had this exact chart right behind their booth. Most people had no clue what it meant. And I started asking them a lot of questions. And I said, so what is this? How do you do this? And they said, oh, and it's proprietary. I said, well, it looks to me like these are just weekly moving averages. A 5-week, a 10-week, a 20, and a 40-week moving averages. And the guy smiled and he goes, yeah, that's what it is. I said, but this TMI histogram down below, now what is that? He goes, oh, that's proprietary. I can't tell you what that is. I said, well, it looks to me like a histogram of a MACD. And he smiled and he goes, yeah, that's exactly what it is. So it's a moving average convergence divergence. So that is their strategy. So what I did was I reverse engineered it. Now, first thing I want to talk about here briefly, and this is one of the subscribers sent me a note saying, why do you use standard scale on your charts? Log scale, logarithmic scale gives you better identification of the trends. And this is exactly his chart. I just duplicated here, but this is exactly the chart that he showed me. He says log scale, look how perfectly it hits these lines. And I said, okay, that's fine. And I sent this back to him and I said, well, here's the log scale and here is the regular scale, standard scale. Now, can you tell the difference between these two?
Not really, no.
There's log scale, there's standard scale. So on a short-term basis, on things that don't move a lot, it doesn't really matter. You can use one or the other. Okay. It's really personal preference. But if you look at something that does move a lot, like NVIDIA, and you look at it over a long period, this is log scale, and this is standard scale.
Oh.
Now can you see the difference?
Yeah.
Log scale, standard scale. So logarithmic scale basically adjusts the price levels to accommodate all of the levels from the very beginning of where this started. You see how the price levels kind of get scrunched together up here?
Yeah.
Whereas if we look at regular scale, it looks at every price level the same.
Right.
To me, it's easier to read standard scale.
Absolutely.
Than it is log scale. But technically, log scale is more accurate, more arithmetically accurate.
Okay.
However, if you're looking at short time frames for things that don't move huge amounts like NVIDIA did, right, it doesn't really matter. It's just personal preference.
Okay.
I wouldn't say one is better than the other. It's just whatever you prefer to use.
Sure.
Now, I'm covering this for a specific reason, which I'll show you in a second. So first of all, on that view from Turner Capital, they said, we look at a total market index. It's one of the things that they say, let's see, where was I? Here. Right up here, you see total market index up here? I said, so what is that total market index? What are you actually
Proprietary.
Yeah, it's proprietary. He said, oh, it's a combination of the S&P, the NASDAQ, the Dow Jones, and the Russell 2000. Unweighted.
Oh.
I said, so you mean cap weighted? And he smiled and said, yeah, basically that's what that means. So he said, that's proprietary. Total market index is proprietary. Well, it's not really. There's something called VTI. This is a ticker symbol, VTI, which is a total market index. It has everything. It has all the things that I just said. S&P, the Dow, the NASDAQ, the Russell, all of that is in this VTI. So there's the top 10 holdings of the VTI. Here's top 10 holdings of the triple Qs. Here's the top 10 holding of SPY, which is for the S&P. So the top 10 holdings are similar. The VTI, though, actually will show everything. All right, so this is again, Turner Capital. By the way, they use a standard scale, not a log scale. So this is going back to 2006, basically. So this again is what they said. This is how we do it. Going back to 2006, here's our buy and our sell recommendations, 5, 10, 20, 40. So I decomposed that and created this using the VTI. So this is theirs, using what they call the total market index. Tell me if you can see similarities here. That's theirs. This is mine.
Yeah.
There's mine.
Okay.
Looks the same, doesn't it?
Yeah, absolutely.
This is what that would look like with a log scale.
Oh.
Now with a log scale, the buy and sell points are the same, but you can see them a little bit better on a long-term chart like this.
Right.
So for long-term, log might be better. But at any rate, this is what they showed. This is what I create.
Okay.
And I can identify where the buy and sell points are. The buy and sell points that they use, by the way. In order to participate with them, the minimum investment is $500,000, and they charge 2% per year.
Nice.
On whatever's invested.
Must be nice.
All right. So I'm going to show you something where all you have to pay is $99 for my website. But I'm not going to invest your money. So this is the one I showed you before, and this is the one that I created. It's exact same time frame. And you can see that they're what they call a proprietary histogram at the bottom. And this is the one I created with the MACD histogram at the bottom. And I had to play around with the parameters to get it to match up with theirs. But I was able to do it. Okay. So there's the buy, the sell points for each of those where these lines cross. There's a number of things that go into identifying for sure. This is the two of those together. So this is theirs, this is mine. Same time frames. You see the histograms down below look very similar.
Yeah.
Right. Now they use a 5, 10, 20, and 40. And I asked them, why do you use those numbers? And he said, well, we're thinking about proprietary. Well, at this point, he knew pretty much that I understood what the heck they were doing. So he started to open up and tell me things. He goes, well, we're thinking about moving to a 50 instead. I said, yeah, 50 makes more sense because that's what everybody uses. Right. So I can understand why you just took 5, 10, you're just doubling each one, but 50 is what everybody uses. Now, what I use is a 5 and 8, a 21, a 50, and a 200. Okay. And I use those because they're Fibonacci. I said, why don't you use Fibonacci up here instead? He had no clue what I was talking about.
Oh, no, you lost him.
I lost him, but I mean, it doesn't really matter. You can use either one. Fibonacci I just like using that because of Fibonacci numbers fascinate me anyway.
Yeah.
But that's, if you look at both of these, they look very similar. So this is what, I back tested the QLD and the QID using their system.
Oh, wow.
I did this in VectorVest. So I can just put the symbol in. I could give it dates, beginning and ending dates, and it would tell me what the return is for those dates for that particular symbol.
Okay.
Okay. Yeah. So using those same dates that I showed back here, I put them in here, and there's the gains. So 11% here, cash, 142% cash, 36% cash, and then 38% up to here. But this only goes to, it goes to November, but we came down a little bit. We actually are just starting to go back up right here. So this would have been the exit point using the entry and exits using this chart. So this one, QLD, which is the long position, would have been exited and would have been cash, would be cash right
Cash,
here,
yeah.
right now.
Okay.
All right, 38%. So you can see the returns. This goes back, what, 1, 2, 3 years.
Yeah, 3 years. Yeah, not bad.
142, 11, 142, 36, and 38%.
Yeah, more than doubled your money.
More than, yeah, way more than double your money. It's like an 80% return. Yearly, annual.
Yeah, annual. Okay.
And
There we
the
go.
important thing is you make money on the downside as well as the upside.
Well, you better be right because you're going twice leverage.
You better be right. That's right. And the other thing that they say, I said, well, do you use stops when you do this? And they said, no, we don't use stops.
Oh,
We only use our entry and exit points.
wow. No stops.
Which is okay if you know what you're doing.
Okay.
With technical analysis, and they
If you have conviction.
do.
Yeah. Okay.
They do know what they're doing. You can see you would have been in cash, right? Or I would have been in cash. This isn't their system, by the way. This is how I would have done it.
Right.
Using the same setup that they use. I added an extra one here for myself, PPO, which gives you a little shorter term time frame.
Cool.
But that's what I would have done. I would have been in cash here. I would have been in cash right now up until last week. Then I would have been back in the QLD again. So I am going to do this. I'm going to play with this system.
Nice.
And I will post the results.
You're going to do one little, you're going to create a, what do you call that? Index or whatever you call those things?
Well,
like 100K basket.
Yeah, the QLD is a symbol that.
No. You did a Kathy Wood portfolio, I think you called them.
Yeah. I'm going to do something similar, but it's only going to be a QLD or QID. I'm going to be in one or the other. I'm going to get out of them.
Right. But are they going to be like? Are you really going to pony up some money, or you're going to do a fake?
No,
you're going to play with money.
I'm going to do real money. Yeah.
Oh, you're doing some real. All right. So what are you going to start this little test with?
Well, maybe next week. Actually, I actually put
no. Not when. What?
What do you mean?
We're talking 50 grand, 100 grand.
Oh no, I'll use 100 grand.
Okay.
I won't put it all in at once though.
No, of course.
I will, leverage in. So this, if you remember this little experiment I did.
Yep.
Best of the best trading candidates. This was real money. When I did this one, I lost less than 0.5%.
Yep.
When the market was going down significantly. So I'm just going to take all this out. I'm going to replace it with this new one.
Okay.
And I will just start tracking it to see how it does.
I like it.
Now, the idea for this is that you should have very few trading opportunities.
Yeah, you don't trade much in this.
You don't trade much in this. You get in when the signal is bullish, and you ride it all the way up, and then you get out when it turns bearish. You move to cash when the market is trying to figure out its direction, and then you get bullish or bearish when the signal shows you what's going down.
All right.
So in this case, there's 1, 2, 3, 4. It's only 4 signals in 3 years, or 4 trades in 3 years.
Yeah. Okay. I like it. This ought to be fun to watch.
So I'm going to see how it does. I mean, anybody that's a member of my site can follow along.
Yeah. Very cool.
See how I do. By the way, these are the dividend portfolio that I just updated. You can see Dividend Aristocrat. I did this on January 3rd.
Yep.
Dividend Aristocrats is now at minus 6.2. This is before last week, right before the rally. Month before was 3.9. Vector Vest scan is minus 7.46, and my own scan that I created.
Oh, Dan in the house.
Up 22%. Now I did not put real money on these. This was just a test, just to see if I could identify using a scan at the beginning of the year and just don't touch it. Just leave everything there, and let it ride.
That'd be fun. We're almost through the year. That'll be good. All right.
Yeah, we're almost done. Yeah, I'll do another one. I'll do another one of these before the first trading day in January.
Nice.
So anyway, that's the strategy that I picked up at the money show. It was fascinating talking to those guys. The lady at the booth said, "Oh, you need to talk to our president. He would love to talk to you. You should have dinner with him. You could spend hours and hours talking to him." They actually went away from the booth, and people were walking up, looking at their charts and everything, and I started explaining how it worked. So the group came back, and I said, "I just signed up 3 people for you while you were gone."
There you go. That's awesome. Well, Dan, you're amazing, man. The audience missed you. I'm glad you're back. Take care. Have a wonderful week.
You too, and have a good time when you're out of the country.
Will do.
A couple of weeks, I guess.